Hi everyone, welcome again to another financial analysis video. I'm Moed Amin and I'm joined by my good friend and colleague, Ted Wayman. So today we're going to be looking at a company that's based in the UK. If you've been to airports, you probably would have seen them, but they're not that well known enough like other companies we've looked at like Twitter and Facebook, etc. So this is a company called Best of the Best and a very, very interesting business actually in terms of their model. Before we get on to that, just a quick note, this show and these videos are about raising your financial acumen, your financial knowledge, your financial practical kind of knowledge. So if you are interested, if you're an avid investor, if you're involved in sales, there's a lot of people that I train and work with in terms of sales. If you're someone that's trying to move up your career ladder, financial acumen, financial knowledge is incredibly important. And that's the purpose for this show, is to help you get there. As Warren Buffett says, finance is the language of business. So if you want to do well in business, you better be able to speak the language very, very well. So do like, share, subscribe. If you have a company you're interested in, as we're going to come on to later on with one of our viewers that requested this, do leave a note in the comments section, give us some context. Make sure that you subscribe, because when we publish the video you're interested in, you will get instant notification. So let's get on to Best of the Best. So quick information about this company. Like I said, very interesting model. So essentially they give away as contests 2 brand new cars per week, and you can actually select the type of cars that you want to potentially win. They have a catalog of those cars, anything, and most of these are very desirable vehicles. And you'll pay a certain amount based upon the category that you want to kind of place your kind of lottery in almost. So and if you win a car, you can win also up to £50,000 in cash, which they put in the boot as part of a marketing play. You can also, if I check this correctly, you get free servicing and insurance for the first year. So you can either choose to win the car, or you can choose to receive a cash equivalent for that car. So they were established in 1999, and so far they've given away £47 million in prizes since then. So quite a substantial amount of money given away. And we're going to come on to the share price as well, because we're going to give you some context as we always do in these videos. But before I go into that, as I said, this company was a request from one of our viewers. So let's look at his request and thank that viewer. So thank you, Pavel, for your request. Interestingly, if you read that, he's looking at this, the share price, and he notes that the price action looks like it's some form of pump and dump, which is very interesting. So stick around till the end of the video, because we're actually going to look at that and look at that spike and, kind of just speculate on what that could mean and connect that to the financial analysis that we're going to be looking at. So just a note on the share price. So floated in 2006. If you'd invested then, you'd be sitting on an increase of 515%, so pretty good. In the last 5 years, you'd be down about 3%. And in the last year, down 87%. So a bit of a hint there around that pump and dump. One other thing to note is, if you're in the UK and you travel a lot, you would have seen these platforms where these brand spanking new cars are being placed on there. And they actually showcased a lot of their vehicles to invite people to pay for those tickets and to kind of essentially join in the raffle. They're in major airports around the UK and also in malls like Westfield. Now, stick around as well, because what Ted's going to show you is there seems to be a discrepancy now from the latest set of the half-year reports, and we're going to show you that. But that was quite interesting to see, and we'll show you that in a second. So let's get on to the finances of the company, Ted. So if you can share that with our viewers, some interesting information in there, and we'll talk about the share price and the potential pump and dump as well.
Absolutely. So welcome, Mary. Thank you very much. And welcome to all of our investors, and welcome to Best of the Best. Yeah, quite an interesting one. I do a lot of travel in my work, and frequent, well, every time I'm in Dubai airport, there's always another Lamborghini or a Porsche or a kind of top of the range, this, that, or the other. And quite interesting, because my first kind of question, I like to go and chat to these guys, and my first question is, well, what about the insurance? And of course, they realize that that's a sort of a natural. Most people say, well, if I won the car, I wouldn't be able to keep it because I wouldn't be able to insure it, £10,000 a year. So they say, we'll pay for the insurance, we'll pay for the servicing for the first year. That's just a way of getting you to buy the ticket. If you want to know your odds of winning, then just look at the financials, because like any company like this, the odds are stacked in the favor of the company who is providing the service. It's a gambling company. That's effectively what it is. You can call it anything else, but it is a gambling company. If you go to Las Vegas and you want to see who wins at gambling, just look at the hotels around you. It's the gambling company who wins, and that's basically what it comes down to. So we as humans, we are driven by our kind of our long odds, big ticket wins. But if you want to make money, you look at someone like Warren Buffett. Okay, he invests long term in boring companies that just produce the numbers year after year after year and are very, very successful. And that is his strategy. So he doesn't invest in kind of high risk, big play, multi-baggers. And I know lots of people out there who do, and some of them will get very rich and most of them will not. So, have a little bit of your portfolio in the kind of the exciting, the kind of the lottery, the gambling end of investment. But my personal opinion is most of your portfolio should be invested in good, solid, well-run and profitable companies. That's my personal opinion, not my advice, of course. Anyway, enough from me on that. Let's get into the financials. Here they are. You can see them on your screen. So the first thing we notice, revenue, really interesting here. Revenue has increased dramatically. So we're dealing in thousands from 2020, turnover about 17.8 million, and it's gone up 157% to nearly 50 million. Okay, so that's basically the ticket sale. So every time you buy a ticket, it's going in there. The cost of the cars they give away, that's in there. They talk about 47 million over however many years. So in 2021, it was 17 million of prize money. So basically, they're collecting 46 million and giving out 17 million in prize money. Hey, you now know who's winning whenever you buy a ticket. Okay, you are not going to win that car. Almost guaranteed. You are highly unlikely to win that car. Probably more likely to share the same birthday with the guy selling you the ticket. So maybe just ask them their birthday before you buy that ticket. Anyway, so they're making a profit of 28 million. So it's a highly profitable business. Admin costs are 14 million, up from 6 million. Interesting enough, this kind of looks like you kind of think, well, they've grown their business. They've grown it quite dramatically here. Now, I've only got 2020 and I haven't looked at previous years. So I don't know whether there's kind of pandemic related stuff going on there, whether they kind of reduced their admin expenses because they didn't employ people because the airports were closed. So you may see that there's a kind of, that there's pandemic figures sort of, represented in that, and that actually 2019 and 2018 were high. As I said, I haven't looked at those accounts. And you can do your own research. The numbers are on their website. This is a listed company, AIM-listed company. No financial income because we live in a low rate environment, and they are paying tax. There's the tax. So the summary is they're making a profit of £11 million, 25% net margin. Very, very profitable business. So for every pound you spend, or I don't know what the ticket price is, it's about £20 or something. So if you spend £20 on a ticket, in effect, half of that money, in fact, less than half of that money, about 40% of that money will go towards buying the car, which somebody else is going to win. And the £5 of that money will go directly into this company's pockets effectively. Okay, so these guys are, that's a good business model, and it's a good winner. And they're appealing to, kind of natural human nature. We like to take those gambles. We think this time it could be you, although it's probably going to be somebody else. Come on to the balance sheet. A very simple balance sheet. So really nothing to kind of, nothing looking sort of hidden here. They've got some property, plant and equipment, about £1 million worth. it's not a huge amount. They don't need a lot. They've got cars which are out there on the forecourt, for example. They won't be their cars. They'll lease those cars, or they'll borrow those cars, and then they'll kind of just buy them and transfer the ownership straight over. So they don't carry any inventory, for example. They'll have tables and chairs. They may have bought a property rather than renting it. But really the balance sheet, 13 million of assets, and it's all cash. They've got 12 million pounds worth of cash just sitting on the balance sheet doing pretty much nothing. And and you notice, just to kind of re-emphasize this, 12 million pounds worth of cash, which is earning them about £1,000 worth in interest. Well, welcome to the world of low interest rates, but that's effectively, so the cash is just sitting there and it's doing absolutely nothing. In the liabilities, they've got minimal liabilities. They've got about £3 million worth of trade and other payables. They can easily pay that because they're sitting on a lot of cash. Liquidity is just not an issue for these guys. So they've got 9 million of equity sitting on their balance sheet, and that is all in the retained earnings in this profitability, suggesting that if they're making all that profit, then they're not paying out a huge amount in dividends. So just to remind ourselves of the profit. So the profit figure was about 12 million. This number has gone up from 2 to 8, which is an increase of about 6. So they've probably paid out about 6 million in dividends. That would be our kind of guess. So the difference here, 8 million from 2 million, increase retained earnings by 6 million. They made a profit of about just under 12 million, and therefore it looks like most, in about 50-50 was distributed as a dividend. Okay, and we'll be able to see that when we look at the movement in equity. That's just the company balance sheet. Here's the movement in equity, and we need to go down to this page here. Here we go. So retained earnings, we're looking at 2020, and we can see there's the dividends paid. So my guess of about 6 million in dividends was correct. They started with 2 million of retained profit. They paid out a dividend of 6 million. They got a profit for the year of nearly 12 million, and they sit on a retained earnings of 8 million. So big dividend. Okay, it's a big dividend. It's a considerable increase on the previous year. Just so we can see, because the previous year, they paid out 1.5 million in dividends on a profit of 3. So it looks like they're 50% is paid out as a dividend, 50% is kept in the company and will be used. I don't know what they're going to use it for. What's their intention? Are they using it? Are they going to go out and find other things to buy? Remember, cash gives you flexibility. We need cash for transactional purposes to run the business. They've got enough of that. We need cash for rainy day. Things go wrong. We get sued, for example. There's a pandemic, and we need cash for speculation. And maybe they're sitting there thinking, we've got all this cash. What should we do with it? Should we buy another gambling company? Is there a natural extension? Is there something that we can do with that? So some interesting conversations going on, no doubt, in the boardroom. Cash flow, as we'd expect, really not an issue. Lots of cash being generated in this business. There's no investment going on. They don't need to. They don't need new tables and chairs, plant, machinery, and equipment. It's just, they've got a cash generating machine. And in terms of financing, they're paying out half of that cash that's generated in a dividend, and the rest is being kept within the business and is sitting in their bank account. So cash flow really not an issue at all. So from an investing point of view, this looks a really healthy company. Let's pull up the share price and just see what's going on in the share price, and this comment about pump and dump, well, you can kind of see why that comment was made. So this is the kind of the pump. So what happens is we pump it all up, and there's a lot of talk, and then people are like, oh, I'm not sure about it. They go, yeah, no, we got to buy this. And then what happens is whoever starts the rumor here, they buy the company, then they start the rumor, they sell out here, and then everyone else realizes they've got a pup and dumps it. So this company is now right down at the bottom here at kind of at a significant discount to its original price, yet when you look at that, the PE ratio, for example, I mean, the market cap is 37 million pounds. Well, just to kind of put that into context, 37 million pounds, the asset value of the business, the net asset value of the business is, I'm just looking at my notes here, is about 9 million. So if you're going to pay 37 million for a 9 million company, there's 28 million of goodwill. Okay, so you're still paying 27 million of goodwill. However, if the company can make a profit of 12 million, would you pay 37 million pounds to buy a company that makes 12 million pounds a year? Well, you kind of think, well, yeah, I mean, absolutely. That's 4 times earnings. Okay. And if you're not sure what we mean by kind of this 4 times earnings, turn it upside down. That's a yield. 4 times earnings is a yield of 25%. Okay. So that's equivalent of investing, putting your money in a bank and getting 25% interest. Now, when I see that, I think, first of all, you think, wow, that's cheap. That's cheap. That's a buying opportunity. The question is, why have we got this kind of, what has driven this big increase in the share price? Well, the numbers we're looking at are at the end of April 2021. Okay, so the April 2021 is round about here. So it looks to me like they're kind of reporting these earnings, and something's happened in the post balance sheet. Something's happened after this, which has caused the share price to come right down. Now, I don't know what's happened. Okay, I honestly, I have no idea what has happened and what has caused. I can see this. Let me just clear some of these drawings. So I can see that, if you suddenly start to report that you're going to be making all of this money, then you can see the share price would go all the way up. Here's the year end, which is April 2021. And then you start to think, well, what's the result of that? Why has it come back down again? So we do have the half-year accounts. Now, the half-year accounts, let's just pull those up so we can see them. So here's the half-year accounts, and we'll notice on the half-year accounts that revenue 19.12. In fact, let's look at the numbers. So we'll just whiz down to the actual numbers. So here's the revenue, and if you make a profit, so if you make revenue of 19 million in the first 6 months, then you're on for about 36 million overall. If you make a profit for the year of, let me just move that up a bit, there we go. So if you make a profit for the year of 2.5 million, which is this number down here, then you're on for a total profit of about 5 million pounds. Now, that's off the pace from previous years, only half of, but it's still not bad. 5 million pounds profit, forecast, is that what they're on for? So what, why is it that, the revenue, the cost of sales, the cost of sales compared with the revenue has gone up? Cost of living crisis, people aren't going to be buying those big ticket numbers anymore. What's going on in this company? Why is it that the future is a little bit less rosy? So an interesting one here, we have a comment from William Hindmarch, who is the chief executive, and he says, we are confident that the business, now operating purely online, is positioned to grow above traditional growth rates experienced where operations were focused on bricks and mortar retail. So this kind of reflects my own kind of lack of knowledge of the business. But are they saying, rather than putting the car in the airport and selling tickets, is it all going to be purely online? Now, personally, I'm not convinced. When people go to the airport, I often see them, they're going on holiday, they're kind of relaxed, a little bit of fun. Let's go to the bar, let's have a drink, let's have a meal here. It's always interesting to see the kind of, the fish bar with champagne is always, very busy in Heathrow, for example. People are kind of in that slightly kind of holiday mood. Let's have a punt on winning a new car. Ho, ho, ho. Wouldn't this be fun type of thing? Are they going to do that in the cold light of day when they're sitting at their computer, looking at all those unpaid bills, cost of living, their energy prices is going up, et cetera, et cetera? Are they going to be making those decisions? I don't know. That's the comment from William Hindmarch. If anybody knows a bit more about this business, then please do share their thoughts. So Moeed, I guess my point from this is I don't think that's pump and dump. You know, that's kind of my feeling. It doesn't look to me like it's market manipulation. It looks to me like this company has had a very, very good 2021, and it's not going to have such a good 2020. That said, if a company makes £5 million a year in profit and its market cap is 40 million, that's not expensive. That really isn't expensive. Now, maybe you kind of think, you know, there's an ethical element to this. This is not going to tick any ESG ethical investments. And therefore those kind of funds are going to be out of this, because this is basically, you know, selling, you know, quite often selling tickets to people who can't afford it. So from an ethics point of view, you may want to avoid this, but this doesn't, you know, from an investment point of view, it doesn't look unreasonable. It's not in my portfolio. I'm not 100% convinced. I don't know the business well enough, but it looks like it could be a reasonably cheap opportunity to buy into a company that looks like it's pretty profitable. But as I said, I don't know the kind of the future strategy, and I think that that's an important part of any investor's decision making, is to understand that strategy and then to buy into that strategy.
Yeah, and there you have it. And the idea for this was, you know, and what we've done here is we've helped you identify areas that you need to question and investigate further from the finances. That's why we look at the share price. A lot of people ask us, why are you looking at share price if you're looking at retrospective numbers? Well, you just saw an example there of why we do that, right? There's clearly some form of alignment, or it's telling us something that we need to investigate further. And that is the whole point of this video here, which is to help you raise your financial acumen so that you can identify those critical things to ask great questions. So love to hear everyone's thoughts and comments. Do leave a note in the comment section. Again, if you have a company just like Pavel did that you are really interested in us analyzing for you, do leave a note in the comment section. Leave some context there, because the more interesting the context, the more likely we're going to prioritize your video. And if you're a subscriber, you'll receive notification when we publish the company you're interested in. So until then, thank you, everyone. Thank you, Ted. We'll see you on the next video and company analysis.
Good to see you, Moeed. Catch you later.